Good evening, Business Finance 330 class. This is Professor Hassey speaking to you live and in color from Claremont, California, and with our week 7 introduction video to our class this week, Online Business Finance. Today's date is Tuesday, March 4th, and I want to go over a couple of things in preparation for our regular voluntary lecture on Wednesday night and some work that you have to do. We're having an assignment number 3 this week, and you're doing a problem of capital budget analysis, very similar to what we're doing in class last week, and which I'm going to talk a little bit about in this introduction video, and we're going to review it also in class, a volunteer class on Wednesday evening. Here is that problem that we talked about in class last week that I'd ask you to try to complete. And what I've done is I've gone ahead and determined the total net project cash flow of this $1 million investment. I filled in the capital budget analysis by taking the sales of 25,000 units at $20 a unit, $500,000 a year. And then I increased that by the inflation rate of 2.5% every year to a total sales of $5.6 million. I took the variable cost of $8 a unit times 25,000 units produced. That's 200,000. And I inflated that at 2% inflation every year to about $2.19 million of variable cost expense. The fixed cost was $50,000. Remember, fixed cost is a total dollar amount, not on a per unit basis, 50,000. And I inflated that 1% every year to a total of around $523,000 of fixed costs. And then for depreciation, I took the $1 million investment and divided it by the depreciable life of 10 years to get $100,000 a year. I took 30% tax of that earnings before taxes amount, and I get our net income for the project, net accounting income of $1.32 million. From that, I included the non-accounting information or cash flow, $35,000 of salvage value at the end of year 10. The salvage value in the problem was $50,000, but I had to take tax out of that since it was a gain on the disposal of the asset in year 10, since we fully depreciated the asset to $1 million. That's a gain of $50,000. What less the 30% tax rate gives us $35,000. Let me make sure I got that. I think that's correct. Yes, 35,000. Then we add back in the depreciation of $100,000 a year because it's a non-cash expense. So we add that back in. And then we take in the working capital. We discussed this in class last week. Working capital is based on the following year's sales, and it's a cumulative amount according to sales. So I take 12% of 200,000. That's $60,000 of negative cash in the year 0. And then going forward into the project, I take the delta between each subsequent year. In this case, it's $12,500. And I get 12% of that is $1,500. In other words, at the end of year 1, we have $61,500 in accumulated working capital cash disbursement, and that's 12% of $512,500. This continues on throughout the year until year 10, when all this cash flow is now no longer needed and added back in. 12% of $624,431, the last year's revenue, is $74,932. And thus I take that now as a wash. If I take 60,000 negative and all these negatives and add back in the 74,932, that's negative or zero sum. It's a washout, which makes sense. I'm dispersing cash to meet the working capital requirements. The project is now financially complete. All that cash is added back in. It's a net zero, but we're showing the accumulation of the cash disbursements during the life of the asset. So we get $2.417 million in net project cash flow. Net income plus salvage value after tax plus depreciation minus working capital requirements plus the add back of the working capital, and we get our net project cash flow. Then we can do the 4 methods of determining our uh, return analysis, which we talked about last week as well. Our discounted cash flow at the cost of capital of 8.83%. The cost of capital is calculated here, and this is the subject of our discussion from chapter 12 on class on Wednesday. How do you calculate the cost of capital, the expected return? So I take the discounted cash flow formula, function, financial, net present value is the function we use to calculate discounted cash flow. And we put in our interest rate of 8.83%. And the values are year 1 through year 10 cash flow total. And that equals $1.510 million of discounted cash flow. Our net present value is the difference between that discounted cash flow and the amount of the investment in year 0. And there's our net present value, $450,832. Pretty positive, pretty good. Our internal rate of return, which is our return analysis in a percent, is equal to formula, function, financial internal rate of return, IRR. And here all we do is put in values year 0 through year 10, and we get our internal rate of return of 17.03%. Our probability or our ratio of relationship of net present value to the investment is net present value divided by negative the investment. And our profitability ratio is 0.43. Remember, the closer to 1, the better. And our payback in years, how long did it take us to pay back the $1,060,000? So at the end of year 1, we had a total cash outlay plus the year 1 project cash flow. That's what's left to pay back. Year 2, we take that balance and add in the year 2 cash flow. There we go. And then we take that out to the 5th year, and notice by the 5th year we have repaid the $1,060,000 cash outlay in year 0. 1, 2, 3, 4, 1, 2, 3, 4 years, and what percent is 211, 987 as a percent of our yearly cash in year 6? It's 0.94. Let's get rid of that dollar sign. So 1, 2, 3, 4.94 years. And that's our return analysis. So overall, this project looks like a winner. It's making in dollars $450,832 in discounted profit. That's a return of 17% when our cost of money is only 8.83%. Our profitability index is 0.43 of 1, and our payback is less than half the time, 4.94 years. You're going to be doing a problem just like this one in assignment number 3. The key part of the problem is not so much the template and doing the numbers, it's making sure you understand the specific items and the pieces of the puzzle to determine your analysis. So that's what we'll be also working on in class on Wednesday. You'll be assess this in class on Wednesday, due Sunday, May 9th, assignment number 3. And then also in class on Wednesday, we'll be talking about how to calculate the cost of capital using the weighted average cost of capital method from chapters 9, 12, and 13. So that's our class this week. A lot to do leading up to a review session this Saturday, May 8th. I'll be having a special review session this Saturday. If any of you would like to participate, it's going to be beginning at 10 o'clock in the morning on Saturday, run about an hour, hour and a half. I'll be recording it. I'll put the link in Blackboard prior to class on Wednesday. So if any of you are interested to participate in that, we'll be going over these subsequent problems and also relaying these problems to the California Best Trucks case. So thanks, everybody. We'll look forward to seeing you tomorrow night at 6 o'clock. Until then, adios.